In this video, we're going to go over the top 6 stocks you're going to want to keep your eye on this week. These are companies who have some major event coming out over this trading week that may lead to an increase or a decrease in share price. We have a combination of earnings reports, investor day presentations, and new product launches that may impact the share price, making some nice buying opportunities or leading to some nice capital gains. Every single company in today's list pays out a dividend, and we have a combination of some lower yield, faster dividend growth companies, as well as some higher yield, slower growth mixed in as well. All of these companies have a major news event coming out this week that may have a direct impact on their share price and have to be on your watch list to keep an eye on over the next few trading days. If you're new to the channel, everyone, I am the Gen Z Investor, and every single day we talk about the stock market, we go over different stocks you can buy and sell, and discuss any major stock market news and headlines. So please hit the like button, subscribe to the channel for daily videos about the market, and we're going to jump right into today's video going over the 6 companies you're going to want to take a look at this week. The first company is Fedex. Currently trading at $289 per share, this company is up more than 81% over the past 12 months. They currently have a market cap at $76 billion with a forward PE just below 18. And they're included in this week's list because they share their latest earnings early on this week. Fedex is a company that has seen a massive benefit because of the pandemic. With the growing of e-commerce, this company has seen a rapid demand for product deliveries all across North America. With people spending more time at home and physical retailers being shut down because of the pandemic, the demand in the surge in e-commerce sales has only increased the demand for FedEx's services. And if we take a look to end out 2020, this holiday season is going to see record high demand for product delivery. And I think FedEx is going to have a very strong fourth quarter this year, and I think their latest results that they're going to share are going to be very strong as well. And Fedex is a company that I believe is going to be a market leader for many years down the road. In this type of industry, there is a lot of high capital costs. I don't see many businesses coming in and destroying the infrastructure that FedEx already has set up. So they announced on December 17th, after market close, we have a revenue estimate at over $19 billion, with earnings per share coming in at $3.94. And over the past 90 days, analysts have only increased their earnings per share expectations 22 times with 0 downward revisions, which just shows as the quarter went on, they were more bullish over this latest report from FedEx. You can see here over the previous 4 quarters, they missed once, but then I've seen 3 consecutive beats, and over the previous quarter, they absolutely destroyed analysts' expectations. In this quarter, we're expecting close to 57% year-over-year growth, and for future quarters down the road, we're expecting massive growth from FedEx as well. 121% expected future growth, followed by 69% the quarter after that. And overall, this company has some strong financial expectations, and analysts are bullish over the next 5 years. We're expecting over 26% per year growth over the next 5 years, and this company has seen 3 upgrades and is rated as a buy right now, coming in at a 2. And the current short-term price target has shares at over $310, so a nice little upside from where they sit right now in that $289 range. So FedEx is a company that does pay out a slight dividend as well. 0.9% dividend yield, a payout ratio of only 16% of their earnings, and they do have a massive 5-year dividend growth rate average. But the company did not increase their dividend as of late and have been maintaining the same payment for at least 5 quarters, so that is why they have ended their consecutive dividend year streak, and it does sit at 0 right now. But overall, FedEx has seen a rapid surge. The new trend of e-commerce sales, I believe, is only going to continue to grow. And I think over this holiday season, it's only going to accelerate the top line growth for a company like FedEx. Moving on to stock number 2, we have Apple. The company currently trades for $122 per share, and they are up more than 80% this year. And this is a company that has seen a slight pullback away from their 52-week high. Back in September, they hit a high at over $134 per share, but you can see shares are down more than 8% from that point. Apple is still the largest company in the world by market cap, currently sitting at $2.08 trillion, trading at a forward PE just below 31, and a current dividend yield at 0.67%. Apple is included in this week's video because they have the launch of a new service. Their Apple Fitness Plus service will launch on December 14th this week, and they just announced a new product, the AirPods Max. This is a new premium form of AirPods, Of course, the traditional AirPods are the small earbuds that go directly in your ear. These are the larger headphone set, the AirPods Max, currently coming out at a price at $550. The traditional AirPods are already one of Apple's most successful products, and I think this new addition, the AirPods Max, are only going to help their top and bottom line over the next few years. But the main reason they're included in this week's video is the launch of their new subscription-based Fitness Plus. The subscription and service industry for Apple has been growing in popularity, and that is a key driver to their future growth. They have so many different subscription models that I believe they're really going to dominate that world, and I think that's really going to be where a lot of their income comes over the next decade. And you can see right here, they're coming out with the new Fitness Plus starting December 14th that will cost $9.99 per month or $80 for a 12-month year. I think this is a huge new addition to the portfolio for Apple, and I think over the next few years, their subscription model is only going to grow, keeping them as one of the market leaders in the tech industry. And of course, with Apple, the dividend right now is small because the share price has been climbing, current yield at 0.67%, payout ratio of only 20% of their earnings, which is extremely low. And this company does buy back a ton of shares, so you are getting a nice overall return from share buybacks, share price growth, and that slight dividend. And overall, the dividend payment does grow significantly, averaging over 10% growth over the past 5 years. So another company to take a look at this week, the launch of this new service, I think is going to help round out their subscription models and really be a key driver for their business many years down the road. The third stock in today's video is Nike. They currently trade at $137 per share, and the company is up more than 41% on the 12-month chart. This is one of the largest consumer brands in the world with a market cap at over $215 billion and a current dividend yield at 0.8%. So Nike has of course had to transition in 2020. Their traditional in-person stores were shut down across North America, so they had to focus more on direct-to-consumer and online purchases. And Nike did a great job from their previous report showing record high growth in online demand, so we'll have to see how over this latest earnings they will do. So they share their earnings after market close on December 18th, and we're expecting revenue coming in at $10.5 billion, with earnings per share at 62 cents. Over the previous 4 quarters, we have seen 3 beats and 1 miss, and over this quarter, we're actually expecting a 12% year-over-year decline in earnings per share. So Nike still has a lot of strong future outlook. Although they're being traded close to a 52-week high right now, moving forward, analysts are still bullish on the company. We're expecting 28% growth next year and over 25% growth per year over the next 5 years, which is still absolutely incredible. The company currently is creeping towards that strong buy range, coming in at a 1.9, and the average price target right now sits at $146 per share, so a slight upside from where we sit today. And this company, of course, is known for their share price growth, but they do pay out a small and growing dividend. Currently yield 0.8%, but they only pay out 38% of their earnings as a dividend, so a ton of room to continue to grow that payment moving forward, and their 5-year dividend growth rate sits at over 12%, so a nice beautiful dividend that, although it's starting off small, is compounding at a very fast rate. So of course, Nike reports earnings this week, one of the largest brands in the world, most recognizable with very strong brand loyalty, and should be on your watch list over this week. If we do see a dip, it might be a nice buying opportunity. Stock number 4 is a high-yield, smaller cap utility company, and that is ticker AQN, Algonquin Power and Utilities. This company currently trades for just under $16 per share. They've grown over 11% this year, and their current market cap sits at $9.5 billion. And this company still has a nice yield at 3.89% and a trailing 12-month PE ratio over 19. So they're included in this week's video because they're hosting their Investor Day presentation on December 14th. And for a lot of companies on the market right now, Investor Days have really led to an increase in share price. Over the past few weeks, we've talked about companies who are hosting Investor Day presentation, and over that following week, they've had some strong guidance expectations, some strong future outlook provided, and the companies have seen a nice sharp increase in share price. So Algonquin Utilities is a company that operates within Canada and the United States. It generates and sells electricity through various different power generation facilities, and they also own both green energy production and traditional energy. So the company also owns and operates hydroelectric, wind, solar, and thermal facilities, as well as the traditional way of generating energy. So this is a combination between a green energy and a pure play energy company as well. And if we take a look at that dividend, current yield at 3.89%, payout ratio is high at 95%. Of course, this is a utility company, so they do support higher payout ratios, but that number is too high for my liking right now. Over the next few quarters, we're hoping they can get that down. And they have a 5-year dividend growth rate average of 10% per year, which is absolutely incredible for a utility company, because those are usually the slower growth dividend payers that only grow between 2 to 5% per year. So AQN has a beautiful history of growing their dividend at a significant rate. Moving on to stock number 5, we have Target. I've discussed them a lot as of late because I'm still bullish on the company, even when they're trading near 52-week highs. Target currently sits at $171 per share, and the company is up 36% on the 1-year chart. You can see this month the company has been up 7%, but they have seen a pullback away from the 52-week high at around $180 per share. So we have seen a slight decline over the past few weeks, and this may be a nice opportunity to get into Target, especially because we're entering into the holiday season. With a lot of small businesses being shut down, Target is one of the name brands that will remain open throughout the entire pandemic. They sell essential products, and that's going to be a huge growth driver for the business over this month and into 2021. They currently have a market cap just under $86 billion, a current dividend yield at 1.58%, and a forward PE coming in just above 19. And this is one of the best dividend growth companies on the market. They are a dividend king with a 52-year streak, which is absolutely incredible. For retailers, it's hard to see long-term dividend sustainability, but Target has proven that through good times and bad times, that dividend will continue to grow. So the dividend is low, starting at 1.58%, but their payout ratio is very sustainable, only coming in at 30% of their net income, so a lot of room to reinvest back into the business, but to continue to pay out a growing dividend for many years down the line as well. And they grow their dividend by a nice rate, averaging 6.47% annual dividend growth over the past 5 years. Finishing off with stock number 6, we have Lennar. Ticker LEN, currently trading above $72 per share. The company's up more than 21% on the 1-year chart, but you can see they have seen a recent pullback away from the $84 52-week high. This is a home builder with a market cap at $22 billion, a current dividend yield at 1.37%, and trading at a very low forward PE of only 9.89. So a lot of value if you were to get into Lennar at this price point. And they're included in this week's video because this is a company that has seen a surge in demand because of the pandemic. People are now escaping tightly packed cities where they're living in rented small apartments and are now shifting towards suburban areas where they can own a single family home or a townhome. And that is what Lennar does. They build homes, and in this low interest rate environment, mortgages are extremely cheap, and they have seen a strong benefit because of that new shift in demand and consumer behavior. If we take a look at Lennar, they do pay out a small dividend yielding 1.37%, and the company's payout ratio is only 13% of their earnings. So it's still extremely low. They do not have a sustainable dividend growth streak, but the dividend right now is still very low for a company like this. And they're included in this week's video because they share their latest earnings after market close on December 16th. We're expecting revenue at $6.64 billion and earnings per share of $2.35. Over the past 90 days, we've seen 14 upward revisions from earnings per share estimates and only one single downward revision. And if we take a look over the previous 4 quarters, they've beaten expectations each and every time in 2020. So overall, they've seen a nice history of beating what analysts are expecting for Lennar. And in this quarter, we're expecting 10% year-over-year growth and some decent dividend growth rates and earnings per share growth rates expected down the road over into 2021. So those were 6 different companies that you should take a look at this week. We have a combination of some major earnings reports, some investor day presentations, and of course, Apple released 2 new product and a new service that I think are really going to help grow the business. So overall, this is a nice variety in this list. We have a lot of companies that they all pay dividends, but like you saw, we have some lower yield companies with faster dividend growth, as well as some higher yields in the 3 to 4% range that still continue to pay out a nice growing dividend each and every year. So thank you for watching. I am the Gen Z Investor. Subscribe to the channel for daily videos with the market, and see you in tomorrow's video.